This year, you pull $40,000 from your retirement accounts. Your neighbor pulls that exact same $40,000 and gets taxed like they pulled out more. Same $40,000, pulled from a different account in a different order. Nobody explains this. The account you reach for first should almost never go first. Nobody ever sat us down and laid out the 3 tax types your retirement money comes in, or told us the order you spend them in is its own decision. So if you're pulling from whichever account feels like the retirement account, stick with me. By the end, you'll know which bucket to tip first and which one to leave alone the longest. Picture 3 buckets sitting on the table. The first bucket is your taxable money. This is your regular brokerage account, your savings, your CDs. You already paid tax on the money that went into it out of your paycheck years ago. So when you spend from this bucket, the only thing that can be taxed is the growth, the gain on top. And if you've held that investment longer than a year, that gain gets taxed at the long-term capital gains rate, which is its own separate, gentler set of brackets. 0, 15, or 20% depending on your income under the 2026 brackets. And for a lot of retired couples living on a modest income, the rate on that growth is that 0. Money you can spend where the growth costs you nothing. The second bucket is your tax-deferred money. This is the big one for most folks. Your traditional IRA, your traditional 401k, a 403b, a SEP. Here's what makes it different. That money has never been taxed, not once. You got a deduction when it went in, and it's been growing untaxed for decades, which means every single dollar you pull out counts as ordinary income, taxed at the same rates as a paycheck, not the gentle capital gains rate, the full ordinary rate. This is the bucket the taxman is most patient about because he knows he hasn't been paid yet. He's just waiting. The third bucket is your tax-free money, your Roth IRA, your Roth 401k. You already paid the tax on this going in, so a qualified withdrawal comes out completely tax-free. And here's the part to circle. The Roth has no required withdrawal during your lifetime. None. The government never forces you to touch it. Not at 73, not at 75, not ever, not for as long as you live. It is the only one of the 3 buckets that is truly, entirely yours. 3 buckets, taxed 3 ways. That's the whole map. Everything from here is just knowing which one to tip first. Trap number 1, draining the tax-deferred bucket first, just because it's the biggest and it feels like the retirement account. Watch what happens. Take a couple I'll call Frank and Diane, 67 and 65. They're both retired, so their income right now is low. And these early retirement years, before the taxman requires anything, are some of the lowest income years they will ever have. Under the 2026 brackets, a married couple filing jointly gets a standard deduction of $32,200. That's income that comes to them at a 0% rate. Above that, the next band is taxed at just 10%, then 12%, all the way up to about $100,000 of taxable income before they even reach the 22% bracket. So these low years are a gift. There's room here, under those low brackets, to pull from that never-taxed bucket cheaply, to move money out while the rate on it is 10 or 12% instead of the 22 or 24 it may cost later. But here's what actually happens in most houses. The couple who reaches for the traditional account on reflex isn't doing any of this on purpose. They're not watching those brackets because nobody ever told them the brackets were the thing to watch. They're just taking what they need, month to month, and letting the rest sit. And that big, never-taxed bucket keeps right on growing, bigger every year, and every dollar of it still owed to the taxman. They think leaving it alone is the safe, responsible thing. It's the opposite. They're building a tax bill, not avoiding one. We'll come back to that when those forced withdrawals kick in, and it won't be pretty. And there's a ripple worth naming. Pull a big chunk out of that traditional account in 1 year, and you can push your income across other lines that have nothing to do with your tax bracket. You can cross the Medicare income line we walked through in the video on Medicare, checking your income at 63. Or you can push more of your Social Security into the taxable column, exactly like we covered in the video on your Social Security still being taxable. Different rules, different formulas, same trigger. Too much, pulled from the wrong bucket in 1 year. So wait, you're telling me the account everybody calls the retirement account is the one I should be careful about draining first? That's exactly what I'm telling you. Not because it's bad, because it's loaded. Every dollar is taxable, and left alone it grows into a bigger tax problem. Let's pause right there. You don't have to memorize any of this. Just know the 3 buckets exist and that the order matters. That's the whole job today. Trap number 2, and this one catches the careful people. Spending the Roth first because tax-free feels like the smart money. I understand the instinct completely. It's tax-free, so it feels like the clever, efficient thing to spend. But remember what makes the Roth special. It's the one bucket with no required withdrawal, ever, in your lifetime. It can sit there and grow, tax-free, for as long as you live. And whatever's left passes to the people you love tax-free too. So when you drain it first, you're spending down the one account that was built to grow untouched, and you're doing it while your 2 taxable buckets just sit there getting more tangled. The trap isn't the Roth. The Roth is wonderful. The trap is the order. But if I save the Roth for last, doesn't that mean I'm paying more tax now, on purpose? Sometimes a little more now, yes. But often far less over the whole stretch, because you're using those low bracket years instead of wasting them. Stay with me, because trap 3 is where that really lands. Now, here's the part that changes how you see all 3 buckets. Trap number 3, ignoring the deadline the IRS sets in your 70s and letting that tax-deferred bucket balloon. Here's the rule, straight from the IRS. At a certain age, you are required to begin drawing money out of that traditional bucket, whether you need it or not. It's called a required minimum distribution. And listen closely, because this is the exact detail so many folks get told wrong, and getting it wrong by a couple of years can cost you real money. That age depends on the year you were born. Born between 1951 and 1959, your age is 73. Born in 1960 or later, it's 75. Your first withdrawal is due by April 1st of the year after you reach your age, and then one every year after that by December 31st. So think about the couple from Trap 1, the ones who left the traditional bucket alone because they were spending the Roth or living on reflex. All those years, that never-taxed bucket kept growing, and now the government reaches in and forces big withdrawals out of it, all of it ordinary income, stacked on top of their Social Security in years when they may have less room under the low brackets, not more. The bill they skipped in their 60s didn't go away. It got bigger, and it came due on the government schedule instead of theirs. That's the cruel part of this bucket. Wait long enough, and you don't get to choose the timing anymore. The calendar chooses it for you, in a lump, in your 70s, whether it's a good tax year for you or a terrible one. And a forced withdrawal that big can shove you into a higher bracket, lift that Medicare line, and tax your Social Security harder, all in the same year. One boulder, rolling downhill, hitting 3 things at once. So the bucket I was proud of leaving alone is the one that comes back to bite me. If you leave it completely alone, yes. The goal isn't to avoid that bucket. It's to draw it down on purpose in the good years, so it's not a boulder waiting for you when those withdrawals begin. And quick reminder, friend, this is for education only, not tax or financial advice. Run your own numbers, or sit down with a qualified professional before you make a move. So let's put the 3 traps together and answer the question in the title. Which account should you drain first? Here's the answer. The account most retirees drain first, that big traditional tax-deferred bucket, is almost never the one that should go first. For most folks, it's the taxable bucket that belongs at the front of the line. The traditional bucket belongs after it. And the account people are most tempted to save or spend early, the Roth, usually belongs dead last of all. So the one you reach for first shouldn't be first, and the tax-free one you might spend early is the one to keep for last. Here's the general order this all points to, and I want to be careful with my words. This is a map, not a rule for every household. First, spend from the taxable bucket. Only the growth is taxed, often at that gentler capital gains rate, so these are usually your cheapest dollars to spend. Second, draw from the tax-deferred bucket on purpose, enough to fill up those low brackets in your 60s and early 70s, so the bucket isn't a boulder waiting for you in your 70s. And third, let the Roth go last. No required withdrawal, growing tax-free for you or for whoever comes after you. Now, hear that as a starting point, not a commandment. A big medical year, a low-income year, a year you're carefully managing that Medicare line or your Social Security. Any of those can flip the order. Your situation is your own. Let me show you the difference with our couple. Frank is 67, Diane is 65. And notice, because Frank was born in the 1950s, his required withdrawals start at 73, while Diane, born in 1961, doesn't reach hers until 75. Same house, two different deadlines. Say together they need $40,000 this year on top of their Social Security. The reflex move first. They pull the whole $40,000 from the traditional 401k. Now remember what that bucket is. Every one of those dollars is ordinary income. So all $40,000 lands on their tax return, stacked right on top of their Social Security. It fills their brackets higher. Here's the quiet part. That bigger income number can reach over and drag more of their Social Security itself into the taxable column. So they end up taxed on money they didn't even pull out. One withdrawal, two problems. Now the bucket move. Say $30,000 of what they need comes out of the taxable account instead. They already paid tax on most of that money years ago, so only the growth on it is taxed, and at that gentle capital gains rate we talked about, maybe even at zero. Their ordinary income for the year barely moves. Their Social Security stays right where it is. And here's the clever part. Because their ordinary income stayed low, there's now room left underneath those low brackets. So they take the last $10,000 from the traditional bucket on purpose while it's cheap, filling up that low bracket instead of leaving the whole boulder to grow. Same $40,000 in their pockets. But they've quietly started shrinking the bill that's coming when those forced withdrawals begin. Same $40,000 either way. Same trip to the grocery store, same money in the checking account, but one path fills the brackets high, taxes their Social Security harder this year, and grows the boulder for later. The other keeps this year low and chips the boulder down. That is the whole difference. Not how much they saved, the order they spent it. And one more thing to tuck away. Those low-income years between the day you retire and the day those forced withdrawals begin, that's a rare, valuable window. What you choose to do with it, including whether to move money from the tax-deferred bucket into the tax-free one on purpose while it's cheap, well, that's its own decision. And that's a video for another day. So here's your one small job this week. Don't reshuffle anything yet. Just pull your latest statements and sort your dollars into the three buckets: taxable, tax-deferred, tax-free. Write down what's in each one. Most folks have never once seen their money that way, and you can't choose an order until you can see the buckets. I even made you a simple one-page worksheet to do exactly that. It's free, down in the description. Go grab it. Now, let me be clear with you, the way a good neighbor should. Everything I've shared today is for education, to help you ask smarter questions. It is not financial, tax, or legal advice. Your situation is your own. So before you lock in a decision, sit down with a qualified professional and walk through your specific numbers. And if you found this helpful, two things. Tap that like button and subscribe if you haven't, so YouTube shows this to the next retiree about to reach into the wrong account first. And type the word order down in the comments so I know to make more like this. Take care, friends.